Hey guys, welcome to another new video. Hope you are doing well and welcome to another new videos. Uh, the subject of our today's video is car loan. So we'll start making videos on car loan from today. So without any further interruption, let's start our today's video. So actually I want to give you some explanation about car loan from Google, and everybody know, you guys know that I give you the information from Google by searching Google. If I get a guaranteed information from Google, then I give it to you through my YouTube videos. Okay, so if we search for car loan, then we get the definition about car loan. Car finance refers to the various financial products which allow someone to acquire a car, including car loans and leases. Okay. Encyclopedia.com. Okay, so now we are in encyclopedia.com, and we'll give you some we will try to give you some information from this website. Okay, car loan. So what it means actually? First of all, we want to know about that actually what it means. Okay, a car loan, also known as a automobile loan or auto loan, is a sum of money a consumer borrow in order to purchase a car. Generally speaking, a loan is an amount of money that is lent to an individual, a business, or another entity. The party that lends the money is known as the lender, while the party borrowing the money is called the borrower. When talking about a loan, a borrower agrees to pay back the full loan amount as well as an interest. A percentage of the loan amount usually calculated on an annual basis by a certain date, typically by making monthly payments. Okay. Car loans follow most of the same rules and procedures that apply to other loans. In most cases, when purchasing a car, a borrower will specially apply for a car loan. However, a consumer can also use a personal loan, a loan obtained by an individual to use at his or her direction. For the same purpose, all car loans are for a specific length of time, generally anywhere between 24 and 16 months, although some car loan can be for a longer period. This types of loan is also known as financing. Car loan generally include a variety of fees and taxes which are added to the total loan amount. Okay. Many consumers apply for car loans at the local bank. When applying for a car loan, a borrower will usually begin by specifying how much money he or she wants to borrow. The borrower will then provide information about his or her financial situation, beginning with income, the amount of money he or she earns by working. Most lenders will require the borrower to provide some proof of employment, usually in the form of a pay stub. The portion of a paycheck that includes information about an employer's earning, which an employee keeps for his or her records, or a copy of a tax return. The form submitted by the individual when paying taxes. The lender will also check the borrower credit report. A credit report is a detailed record of an individual past credit, in short, borrowing activities, whether in the form of loans or other debt. If the prospective borrower has a bad credit story, he or she may be ineligible for a car loan. Often a bank or financial institution will pre-approve certain customers for car loans. In this situation, a consumer has a certain number of days, often 30, sometimes 45, to decide whether to seek full approval for a car loan. Because most borrowers secure a car loan before actually shopping for a car, When an application for a car loan is approved, a lender will generally give the borrower a maximum amount he or she will be able to borrow. The borrower is then free to use this money to purchase the car or of his or her choosing. However, the borrower is not required to spend the full amount offered by the lender. For example, while a bank might approve a car loan of $15,000 for a long-term customer, that customer has the right to spend only a fraction of the amount. What did it begin? Okay, the car loan officially originated in 1990 when the General Motors Corporation, an automobile manufacturer founded in 1908 in Flint, Michigan, established the General Motor Acceptance Corporation or GMAC. GMAC arose in response to the growing demand for automobiles among American consumers after World War I. In 1919, GMAC established offices in 5 North American cities. A year later, it opened its first office in Great Britain. As the car loan business expanded, other automobile manufacturers began to develop their own financing division. One of the most prominent was the Ford Motor Credit Company, founded in 1923. Although car loans are available, most American consumers during the first half of the 20th century paid cash for their automobiles. More detailed information. When a borrower takes out a loan on a car, he or she is agreeing to buy the car. Upon entering into the loan agreement, the borrower gains the right to drive the car while also taking possession of the car title, a document showing proof of the ownership of a piece of property. Technically speaking, however, the borrower does not yet own the car. The lender owns the car until the borrower has finished paying off the loan. Each car payment consists of 2 parts: the principal, the original amount of the loan, and the interest. Interest on car loan depends primarily on 3 main factors: the credit rating of the car buyers, whether the car is new or used, and the price of the car. As a rule, interest rates on a new car tend to be lower than interest rate on used car. Also, as the price of car goes up, the interest rate will usually go down. For example, if a consumer wants to purchase a used truck listed for $2,500, the loan interest rate might be 6.49%. If that same consumer wants to purchase a new car in $14,000 Lexus, the interest rate might only be 5.49%. So that's the difference between these two comparisons. So that's all about our today's video. If you like our today's video, then don't forget to subscribe our YouTube channel to get more videos like this, and thank you very much for watching our videos. Thanks.